going to go through what underwriting commercial real estate properties. We're going to start with what is the price per square foot? What is the cap rate? What are the comps? Is it a deal? And financial freedom.
So price per square foot is a metrics that investors use to determine whether, it's one of the factors that we look at for a property. Rental income compared to cost of ownership. So, how to know when the price per square foot is too high. So in order to figure out the price per square foot, you want to take the purchase price and divide it by the gross livable area, which should be on that offering memorandum. So it's a simple calculation, but it's a very important metrics to be able to determine if it's a type of property asset that you want to acquire.
Great. And how would you know when the price of the square footage is too high?
Well, with us at Money Management, we typically like to see, it really depends on the asset. If we're looking at a retail property, we don't want to see, it also depends on the market, but we're looking for, maybe around $120, $150 per square foot. Everyone's got different strategies. But if you want to follow Ben Soifer's, his strategy, he tends to want to have the most competitive price per square foot, something that's under market. Those are the great deals. That's what you want to find.
So the cap rate's something you hear a term thrown around a lot. And what we want to help you understand is what the cap rate is. And that's your return on the capital without leverage. So that's something that's going to be really important as you're evaluating a property. So to calculate the cap rate, you're going to use the following formula. You're going to take gross income minus your expenses, which equals your NOI, your net operating income. You're then going to divide your NOI by the purchase price, and that's how you're going to arrive at your cap rate. Here at Money Management, we obviously are looking for cap rates that are going to be advantageous to us. So right now, Alex, why don't you tell us about the cap rates that we're looking for the fund?
Sure. And the way we determine what cap rate we're looking for, you have to take a look at the market and see what the cost of the debt is. And knowing what you want as your return will really help you understand what cap rate you should be looking at. For us, for example, borrowing money right now, commercial real estate loans, we're seeing around 6.25% to 6.75% interest rates. So depending on the amount of return you want to make, for us, we want our investors, so we want a 2% spread, return on our investment. So with cap rates, we as an investor, we are looking for cap rates in the 8.5% range. I heard somebody say, "Oh my God." Who was that? Is that August?
Yeah.
August, glad to have you on board. What do you think about the cap rate? Is it a little bit too high compared to what you're seeing?
No, it's more like 4.5, yeah.
Okay, so there's different strategies. If you're looking to invest more for an appreciation type return, you're looking for your property to increase in value, not so much about the cash flow. There's different strategies. With us, Money Management, we are looking for cap rates in the 8.5% because we are a fund and we want to make sure our investors secure their return on their investment.
And I think you're the best person to take this one away because you've been making great deals for a long time.
That's right. It's all about making a deal. It's all about finding a deal and really getting down to the basics. In the previous slides, we were able to see kind of, what are we evaluating the asset based on, as far as the how are we coming up with the evaluation, whether it's the income approach or whether it's going to be the cost of, the structure, which is the price per foot. Having an added value to a project, to a potential, acquisition is something that every investor should strive for. If you can't really see how you're going to be able to raise that NOI, raise the income that you're receiving, then that's okay too, as long as you're good with that acquisition, with that asset. The leases, obviously it's important to focus on Strong tenants, tenants that have been around, tenants that are COVID proof, tenants that are service oriented, grocery stores, dialysis clinics, restaurant industries, chains. And then how difficult is it to really manage the asset? Do you have 6 tenants? Do you have 24 tenants? And are they triple net leases or are they modified gross leases? So again, if you're not familiar with the terminology that I'm using, definitely you want to look it up and you want to talk to us about it, because it's all about getting more educated as you try to really find something for yourself or for your team or for a client as a consultant that's going to really be long term.
And if I may interject, hey guys, I hope you're listening because this type of information is not available anywhere else. That's what's so great about this workshop here. You guys are a part of it right now. We're excited that you're learning this. Really absorb what Ben is saying because I'm learning it now, and it's stuff that I was not able to find outside of this type of relationship. So some great information here, and there are a few other points that I thought Ben had mentioned to me that I learned from Ben that I thought I could mention here really quick. What is the property next to? Is it next to a gas station? That's a red flag. There's environmental issues, things like that you want to look out for. So not just the property itself, but what's close by it. How many vehicles per day drive by the property? Ben wrote in his recent book, Manual for Real Estate Investors, 20,000 vehicles per day is a good indication that it's a busy location. So these are things, some great information that you can learn. What's the management fee? Who is the management team? Who's running it? You may want to have them stay on depending on how much they're charging to, help you manage that property so you can carry on about your day. Also, a couple other things like how long has it been on the market? Is it a stale listing? You might be able to get a better deal. How many offers are on there? On the table right now. So some of the questions that you can ask the seller to help you get a better deal.
Yeah, it's definitely, these are very valuable points. And, with technology being where it's at, it's really important that you guys Google. You Google the property, you're able to see whether it's next to a gas station, like Alex mentioned. So these are types of red flags you can kind of counter on your own without even needing a broker or someone or an appraisal to really give you the inside scoop on it, with Google Earth. The location, how rural is it? How metropolitan is it? And then as far as the other points that Alex mentioned, it's really important that you find out how realistic the management fee that they have, that they're underwriting the deal with, right? Let's say they're underwriting the deal at 3%, and you know that it's going to be 5%. You have to adjust your numbers, right? This is what this workshop is really for. When you underwrite a commercial deal, you're making your numbers as realistic as possible with, I would say, a 5 to 7%, buffer, just to make sure that you're always going to hit your numbers. So, definitely management fee is one of them. And then property taxes is another one. You have to double check because it's state, respective. Obviously, different states have different property tax ratios. And unless you're going to underwrite it based on the right number, that could really skew you off, especially if the leases are not triple net. Even if they are, it could skew you off. And remember that the other party, whoever's selling you the deal, the representative on the other side, and not to call out any companies, but again, everybody does their job well in representing the seller. And in commercial real estate, like as we all know, it's like the Wild West. So they're going to show you numbers that may not be realistic. And that's why you as the investor, you as the consultant, really have to make sure, okay, if it's a state where, the property tax isn't disclosed as far as what you bought it for and the basis, and now, like Texas, and now the brokers are telling you, don't worry about it. It's an undisclosure state. That's not true. You have to worry about it. You're the one who's going to get the bill, At the end of the day, whether you can pass it on to your tenants or not, it's still going to be your bill. So if you're supposed to pay 2.8% and they're paying 1.4% on a $5 million property, it's going to be a big difference. So it's really important that you underwrite the deal properly as it reflects to management fees, as it reflects to property taxes, and then hopefully they're all triple net deals. You don't have to worry about the other expenses.
We're coming to the end of our time here, so I just want to remind everyone that we thank you for coming today, and our next Lunch and Learn will be Steps on Becoming Financially Free right before the Christmas season here on December 20th. All of our classes can be found online as well. And referencing back to what Alex had talked about is the book, the manual by Ben Soifer, and we have Brielle Soifer joining us here today as well. And it's a manual for the ultimate real estate investor. And we would love to have you guys check that out and get your copy. It's on Amazon is the easiest way to find that.